This is your Mortgage Rate Watch for Wednesday, February the 2nd, and I'm Keith Akada with the Mortgage Reel. Things change so quickly in the stock market and global markets, and it also directly impacts how quickly rates can change. As you can see on the bond page, yesterday we were trying to stabilize some. We're talking about how there's this floor of support and a ceiling of resistance that we've been battling to keep interest rates from moving any higher and interest rates, unfortunately, moving from any lower. Well, that's come up again today as interest rates had some good and bad news from both local and domestic. But the biggest thing that's coming out right now is what's going on in Egypt, and then moving into Friday's job reports. And as you can see, both of them have pressured the market to turn down, and rates are worsening at this moment. Just yesterday, we were talking about how traders in Wall Street were feeling that the situation in Egypt would not escalate into any more violence. And again, here, just changing overnight, the Egyptian citizens are out rioting and protesting in the streets. And this comes on the demand for the Egyptian president, Hosni Mubarak, to resign. He just stated that he will not go for re-election in September. But now what we're feeling is that the citizens will not stop the rioting or the protesting until Mubarak actually resigns from office. The U.S. bond market, again, being a safe haven for global investors, we're showing that those funds are coming back in because of the uncertainty and what's going on in Egypt. On the flip side of that, because of economic data that's coming out here in the United States, that the jobs report is showing better than expected numbers, even coming out on Friday, which we'll talk more about tomorrow, what we anticipated to come in at. The biggest thing that's coming here is signs of inflation and really what quantitative easing is going to do. With the numbers not coming in as good as where the Federal Reserve wants them to be, with unemployment rate reducing and still fueling the stock market above this 12,000 point level, the Federal Reserve will still kick in that full $600 billion into the economy. And this is where many of Wall Street, many analysts across the board, economists, all saying that this is going to push us into the inflation that we're expecting in the summer. Keep in mind that many have already pointed out, with inflation and what the Federal Reserve is getting ready to do to release all of these funds into the economy, it's going to push interest rates between the 5 to 5.5 level, most likely by June. And that is a speculated time frame. You can't hold us 100% accountable to that, but that is what's being speculated. That's what's being told to us from both our banks, everything we're hearing in media, our investors that we do business with. It's all coming across the board. That's where everyone's expecting interest rates to move to. More to come from Homeowners Education 101 as we put the final touches on the 2011 forecast for housing and mortgage rates. Leave any comments or feedback below, as it's not only appreciated by Team Mortgage Reel, but also by current and future viewers. Join the conversation on Facebook at How to Beat the Banks and like us when you're there. Otherwise, we'll be back tomorrow with more updates on your Mortgage Rate Watch.